We'll go ahead and get started. Uh, if you would just raise your hands if you can hear me. Looks like my end's working well, and hopefully yours is too. Okay, so we're going to go ahead and get started. And so we're doing these market updates on the webinars on a quarterly basis, and then we do a print version every other the month, so we don't do a live market update. We should be able to record this and have it available for a brief time to review, and those who couldn't attend and make it. So I'll go ahead and get into it. Of course, most of you guys know who we are and what we do, and we basically help clients in growing and protecting their wealth, and been at it for a couple of years now. And let's just get into the market summary here, what happened in the first quarter and, of course, year to date. So we can see that the markets have rebounded substantially in the first quarter. The heavy tech NASDAQ jumped more than 16% for the quarter, while the broad market S&P index rose approximately 7%. The Dow focused large cap Jones was only modestly higher. International markets also rebounded, and we see there where the small caps have come up some, and of course the international stocks have actually rebounded much greater than the broader market in the US. We turn our attention toward materials and commodities. Last year was a huge year for materials and commodities, with oil prices rising well above $80. Since then, this first quarter, basically crude oil ended down roughly over 5%, and but year to date it's just a little bit underwater. The energy sector, such as energy stocks, service stocks, oil and gas stocks, were down as well for the quarter, and year to date down about 2%. Material stocks continue to edge a little bit higher. What we had was, copper was up a little bit. Copper rose 7.5%, and basically the silver ticked up about 0.5%, and crude oil ended down, as I mentioned. We're seeing gold having a nice year, up for the first quarter 8%, and year to date 9.3%. So I'm going to touch more later on about gold and silver, but we look at bonds. With interest rates rising, of course, fixed income securities were down across the board last year, and the Federal Reserve raised the federal funds rate 7 times in 2022, and with possibly more on the way in 2023. Recently, the current Fed now rate sits at a range of about 4.8%. But with the banking issues that we've had late, along with the Fed's possibly slowing rate increases, bonds have actually rallied this year as interest rates have come down a bit from recent highs. So what that means is rates have kind of pulled back on the Treasury rates and the mortgage rates and longer term bonds, and so therefore bond prices have increased a little bit, as you can see on this chart here. So as part of being a successful investor is recognizing the important inflection points in market sentiment. So when prices and valuations are stretched like they have been over the last year, you start to get stock tips from your barber, and may make sense to trim your risk and raise cash and become defensive. And that's kind of what we did over the last year or so. And on the other hand, when investors are in panic mode and selling stocks indiscriminately, it's probably a good time to put together your shopping list and do some buying at some point. So what we've seen here, I'll draw a little chart, we've kind of been in, last year, the beginning of last year in 2022, we had this euphoria area here. And then when the market topped out and it began to go down, the markets did, you you get sentiment that's uneasement or denial, and then eventually pessimism. We had maybe perhaps some panic selling here and there, and then capitulation. We really haven't had a huge major capitulation yet, but we are starting to see some areas of hope and some relief. We're kind of making our way up to that. So even though the general market is still kind of in a bearish mode for a lot of stocks, we are seeing sectors that are starting to bottom out and starting to look much better. So keeping in mind this kind of market sentiment, this deals with emotions. So you ride those waves, and you have to really kind of have a good disciplined investment process to kind of keep your mind straight and not get emotional about these things. But when we do start to see things that are really a lot of bad news, like we've had in the last, really year, that can set the tone for the market putting in a bottom and at some point reversing. We're possibly seeing some stages of that in this area here. So just to get your sentiment of the markets, I'm going to release this poll. I'll try to here. So on the first poll, I'd like to launch this one that says basically, where do you think we'll end up on the markets by the end of the first quarter? Excuse me, it should be the second quarter of this year. Do you think we'll be up, down, or have no clue? So if you would take just a minute to review that and get your responses. Okay, so basically we have about a third saying we're up for the quarter, this next quarter coming, and then a third saying basically down, and then a third no clue. So I'll share those results with you, as you can see there on the chart. Okay, so next slide, we're going to talk more about things that could cause stocks to stall. One is, of course, if the Fed continues to raise rates, which there's a possibility of a pause in rates going higher due to if the recession is much worse than people we could imagine, then the Feds could actually ease rates at some point. But right now they have voiced their intent to continue to raise rates, even probably at a modest quarter basis point. If we see inflation, which we're starting to see it ease up some, and if the economy starts to slow, we could see inflation go down. However, if inflation were to continue to move higher, then the Feds could resume their more aggressive raising of rates. As I mentioned earlier, the recession, if it's worse than what the market is pricing in right now, that could be a spell more of a stall to stocks in general. And then, of course, you have a political or geopolitical fallout. I mean, that we're seeing that around the world right now with the war in Ukraine and with Russia. We've seen things with China looking to strengthen their power up on Taiwan. And then also talking about black swan events. This is something that comes out of nowhere that catches everybody by surprise, particularly the markets. Those are some things that could happen. And so therefore it's good to be, I think at this time, to be diversified in our strategies, and also having gold and precious metals in our portfolio that will help balance out any rough rides. Let's talk a little bit more about inflation. As you can see, some of the recent pricing and inflation is a little over 5% right now. With the red line is the CPI, which is a consumer price index. This is kind of the headline inflation. It basically publishes this inflation rate each month, and it excludes food and energy, which can be volatile, but make up a big part of what people on the lower half of the income scale spend their money on. So the inflation rate has slowed, as you can see from the peaks. It shows a lower than expected rate of inflation of around 6%. That's down from a peak in last June of 9.1%. So core CPI, which excludes, like I said, energy, also came in below expectations recently. Although inflation appears to be slowing, it still remains far above the Fed's 2% target. Now, this blue line we see here is based on the shadow stats, based on the 1980 alternative method that we used to use. It has inflation right at around 15%. So that could be more of a true inflation factor. Over the years, they have kind of watered down basically the statistics that make up for the CPI. That's why we've seen inflation at really historical lows in the last 10 years or so. Let's take a look at the big picture here. So this is a chart going back to 1900s, early 1900, and it's basically showing what the markets have done. So the periods of red here are the periods of where the markets don't do anything or very little or downturning. And these are called bear markets. On this lower part of the graph, what you see is the price to earnings ratio. In this particular case, this is looking at the Case-Shiller price to earnings. And what you see is that during these bear markets, the prices of stocks tend to turn lower. And typically they have to get like at a 10 level in this range in order for the markets to set the stage for a new bull market. And so what we have here is we have the stocks currently, we're in a bear market. As you can see the red here as of the end of the year. This is factoring in the new bear market that we've been in. So the Case-Shiller price index, the pricing of stocks have come down off their highs recently. Here, it's around 29.35. They came off their highs of around near 40. And what this tells us basically is that stocks have become cheaper recently, but they're historically still high compared to the 100-year average, a little over 100 years. And so when you think about the next 5 years, 10 years, there's a good possibility that we may have to see stocks come back down, at least in the 10 level or the teens level on this Case-Shiller price index number, in order for stocks to have a longer term bull market. So what we do is here at our firm, we look at fact-based investing, because you hear lots of things on the news, you hear lots of opinions, recession possibly to, banking crisis. So there's a lot of news, there's a lot of noise we see in the market. But at the end of the day, what we have to do is focus on what is the market telling us. The market is very efficient, and we want to go to a foundation of making good decisions is based on what the market's telling us. And so that's called fact-based investing. And it's all about supply and demand. The more supply you have of something, the cheaper it is. That's in any kind of form of, whether it's Beanie Babies or whether it's oil and gas, and whether it's stocks. So if you have a large supply of stocks that is being sold and there's not much buying, then you have lower prices. But on the other hand, if you have higher demand for something, you're going to see prices increase. So when you looked at a fact-based investing, we try not to make market predictions. It also does not require that markets or investors be rational or efficient. And it does not remain fully invested regardless of the market circumstances. So when we implement a fact-based strategy, here are the main things that we look at. And it focuses on more what is instead of what might be or what ought to be. And so we look at the bull-bear indicator. And what we have today is we're still, as of March of 2022, we entered into a bear market back then. And as you can see, the indicator fell substantially, and this is the S&P below, and it also fell during that time. We're now starting to see a bottom being put into the S&P 500, and we're seeing a little bit of rally off those lows. So right now, even though the general broad market is in kind of more of a bearish type mode, it has increased a little bit in strength. Not quite yet above the green level, which it needs to get above there before the general market. Now, that doesn't mean there are pockets and areas to make money in the markets. It just means that the general broad market is still kind of more in a bearish mode. We also seen that in bonds. When interest rates started going up tremendously over the last year or plus, is we've seen bond market go into a bear market in October. That means rates were going higher, bond prices moved lower. So we are still in a bear market for bonds, although short-term rates have increased in the last year and a half. Longer-term bond prices have moved up some as well, and therefore you're seeing bonds being under pressure. Now, at some point, if the Fed start pausing or the Fed start lowering rates, we could see a rally in the bond market. But for right now, it's still in general in a bearish mode. International stocks went into bear market territory back in February of 2022, about a month before the US stock market. And it has actually returned to more of a bull status recently. And so that's encouraging as well. Now let's talk about the Fed funds rate. So in its latest economic projections, Fed officials now expect the economic growth to be slightly lower this year and inflation slightly higher than they predicted in December. So this shows a history of the federal funds rates that they were high. Of course, you can see back here in the 1980s, and they peaked out and have been going down tremendously ever since, bottomed out, and now they're on their way up. So they also forecast raising interest rates to 5.1% by the end of 2023, but they do anticipate perhaps them coming down to about 4.3 by the end of next year. So the Fed move matched last month's increase in size, lifting rates to a range of about 5%, according to the New York Times. Real estate in general, particularly office space and other types of real estate investment trust, still remains in a bearish environment that went negative back in May of last year. So as interest rates rise, what you're going to see is when companies have debt on their books, and those who are highly leveraged with debt, at some point will have to renew those rates at a much higher cost if rates continue to stay higher. This could cause some concern in perhaps more fixed type investments like a real estate investment trust / utilities, which don't have a huge profit margin. And if they have a lot of debt, that also kind of cuts into their earnings. So as rates go up in general, you see companies are going to have a higher cost of their debt, which could put more strain on earnings and their profits. Excuse me. Talk a little bit about energy stocks. This is measured by a fund called the XLE, which has most of the major oil and gas production, and also your processing plants and everything else for fuel and oil and gas type related. It has improved some here, but it also still remains in a bear market just recently in March of this year. There's could be some good opportunities, we still think, in the energy sector. A lot of them are paying very high dividends. And long term, we don't see energy, particularly fossil fuels, petering out anytime soon, because our electrical grid is really not set up for all the new electrical cars and everything else that we're going to have, or at least that they're promoting. So energy, in our opinion, still does hold some value, but it right now it's a little bit more weakness in the energy market, with oil dipping just right around $60 per barrel and coming off the highs of 80 plus last year. Now let's talk a little bit about gold. We're seeing a rally in gold. We have recommended here at least 10 to 20% of precious metals to protect against market uncertainty and, of course, inflation. And as you can see from our gold strength indicator, it turned bearish last year when gold prices eased up and silver as well, but now has rallied since. And so we're back into a bull upward trend in gold and silver and many of the precious metals. We take a look at gold over the years. This chart goes back to before the crisis of 2008. As you can see, gold prices in the black here rose substantially during this crisis we had in 08 through 09, 11. It peaked out here, and then it went on a downturn, but then it reversed its downturn back in around 2019, 2020. And has rallied again. It made a new high, but now recently is making newer highs. So we're seeing it break out of this level here, and that is very bullish. And it's up 8% as of March 31st, and up over 20% since the November 2020 lows during this time. And this is measured by the Spider Gold Shares ETF. So when we think of gold, there's been a lot of accumulation of gold in the central banks around the world. We're starting to see signs of moving away from the US dollar, which is huge. And we have a huge amount of debt. A lot of these countries own a huge amount of US treasuries. Recently, the BRICS nation, which includes, Brazil, Russia, India, China, and South Africa, and there are several other smaller countries now attaching on to this. So the ties between Russia and China and India and other BRIC nations appear poised to go a step further in protecting their currency with the formation of a new currency. And so according to some of the reports, and quoting a Russia lawmaker, Alexander Bakov, the BRICS nations are in the process of creating a new medium for payments internationally. So established on a strategy that it does not defend the dollar or the euro. So basically, the Babakov, who is the deputy chairman of Russia's State Duma, reported that the new currency would be secured by gold and other commodities such as rare earth elements. This is a source from the India Times. But if you Google this, you'll see there's a lot of news in relation to this. So this bodes well for commodities, particularly gold, silver, and perhaps other rare type earth metals. So this is very important to keep an eye on. And I think over time, more and more countries may jump onto this, because historically these countries have had to use the US dollar, purchase the US dollar, and buy or sell their their oil and other commodities in the international markets. So these countries are now saying, hey, we've had enough of that, and we're starting to form our own that is going to be backed and secured with gold and other types of commodities, particularly rare earths. So when you look at the gold prices in the US dollars, as you can see that gold in the gold here, the yellow shows that, and the blue is the dollar, US dollar. And they have a fairly, what we call an inverse relationship. So it's a negative correlation to the US dollar. So emerging countries are, like I said, are developing an effort to distance themselves from the US dollar hegemony. And basically, according to this article, it was reported that the new currency would be secured by gold and other commodities. And so what we're seeing is gold starting to strengthen again against the US dollar. And here again, this is another good reason why we should be exposed to gold and precious metals. Now, it doesn't mean that gold's just going to go straight up from here, and we don't want to put all of our eggs in one basket at this time. There could be some point where we increase our silver positions. That's probably one that has a huge huge demand for industrial, medical, and of course, all this new green earth stuff, new green deals that have gone on with the cars and batteries and everything else. Silver is a key component in that. So we're very bullish on that long term. So as far as some of the sectors to invest in today, perhaps the near term, of course, if we looking at oil and gas stocks, we've increased a little bit of positions there. And as I mentioned, metals, commodity stocks as well. And we've just recently added the defense stocks to our models, which are the big defense firms. So with the war drums beating around the world, it seems like defense stocks could be a good place also, and more of a defensive play. A lot of technology stocks are starting to put in bottoms and starting to reverse higher. And so there could be a resurgence of some of the tech stocks. And we've also increased our exposure to the NASDAQ 100, which is pretty heavily laden with technology stocks. And then, of course, cash and money market. Having some cash and money market set aside as dry powder to hopefully take advantage of opportunities when we see them and when they happen. So those are a few areas that we really are kind of focused on more at this time. So to get your opinion, what are your thoughts on you think the market will do? So I'm going to launch this survey. And if you would like to take that, what do you think will end the market for this year? Up strong, 10% or higher, up slightly, down to flat, or down big? If you would like to put your polls out there, we'd love to see what you're thinking. Okay, we've got, looks like here, a lot of people are saying that we're going to see the market up either strong or a little bit more is up just slightly. So with the markets up year to date, most of you think that we're probably not going to see too much upside from here. Nobody's expecting, at least on this webinar, to see it go down substantially. Okay, so we'll move on here. And basically, that's kind of what we talk about, is just concerns. If you have concerns, we'd like to hear them. Would love to get your feedback on today of this brief update. So what are your biggest concerns about the portfolio and the markets? Would love to hear that. And then please share that with, if you'd like to type in any questions. I'm going to go ahead and looks like I was muted. I apologize for that. So any concerns that you guys might have, if you want to type those in and just as questions, I'm going to leave it open here just for a few seconds to see if there's any questions that you have in relation to this presentation or in general. If you want to type in your little Q&A or questions there, I'll try to answer those before we end our session. Okay, no questions. So we're going to go ahead and conclude our series today. Before we do, it's important to know where you stand with your investments. If you have accounts with us, you hopefully you're kept advised on that. But if you don't, if you have questions with other things you have going on, whether it's a 401k or other retirement plan that's outside of our management, we can help you to identify some laggards in your portfolio or suggestions to adding strength, or to even how to help reduce risk. And then also, I have a lot of people calling me, especially with this banking crisis we've had recently, and doesn't mean it's over because the headlines aren't, showing too much on it now. But I think it's important to be better prepared in your personal planning. So if you'd like to discuss or get information on some actions to implement how to be better prepared in the event of a disaster or catastrophic event, I've helped many of our clients do that here recently, and we can go through and just talk about some things that you can do personally to be better prepared. So if you would, complete your survey after this webinar, and we will follow up with you and hopefully help you be better prepared and answer any questions you might have. I'd like to thank you for attending our seminar today, and look forward to talking in the near future.